Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the acid test ratio, also known as the quick ratio. As I do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, then we'll look at some examples and give you a little bit more insight into the actual use of the ratio in this case. The acid test ratio is a measure of a company's ability to meet its short-term or current liabilities using its most liquid current assets. The ratio is calculated by subtracting inventories from current assets and dividing the quantity by its current liabilities. A higher acid test ratio indicates greater short-term financial health. However, if the ratio is too high, it can be a sign that a company is a potential hostile takeover candidate. The acid test ratio is more conservative than the current ratio, which measures much the same thing, because the current ratio includes the value of inventory. Inventory can be less liquid than other current assets, thus the acid test ratio measures a company's ability to meet its obligations in a worst-case scenario. The formula for this particular ratio, let me get the tools right quick, is simply cash plus accounts receivable plus short-term investments, and you divide that total number by the current liabilities. The acid test ratio can be found almost anywhere. A lot of places will just give you the figure on some kind of a key statistic area. What we're going to do is show you exactly how to come up with it. And we're right now on the Google Finance page looking at Intel Corporation. I'm going to click on the financials here and go over there to the balance sheet. That's where you're going to find the information you need. Scroll on down here. Get this out of the way. Alright. Okay, the first thing you want to do is add up the cash and cash equivalents. So this one here, the short-term investments as well. And then you will notice on this particular page you've actually got them totaled right here, cash and short-term investments. It's right over here, and I'll show you that in a minute. And then you want to also add in the accounts receivable right here, and that's over here. So when we add up all these numbers, let me scroll over there so you can see that. What we're going to do is simply take these numbers, get that out of the way, there. Okay, we take the cash, the short term, and then we add in also the accounts receivable. When you get done with all that, again, like I said, this number here is these two numbers already added together. So we simply take these two numbers together in this case, and we add them up. The total here would be roughly 17. We simply divide that number by current liabilities, and the current liabilities will be further down on the page on the balance sheet. So let's clean that up and go down there a little bit and see what we can find there. Okay. I can't actually get both of them in the same frame, so total current liabilities right here. You just go over here and it's 10.5. I'll show you that right quick. Go over there. Okay, 10.5 right there. So we take that earlier number of 17 and we divide it by 10.5 and we get a 1.62. The current ratio with a company's current ratio less than 1, it means they cannot pay their current liabilities and should be looked at with extreme caution. That's going to be the case oftentimes with retail companies, as they are heavily reliant on their inventories and actually being able to turn those over. So that's something to look at whenever you're looking at a company. However, there is one more detail you should know. If it's too high, like for example, 1 is the benchmark. So if they have a 1, that's they can meet their current liabilities. You'd like to see 2, 3 would be awesome. If it got up to 10 or something of that nature, it'd be way too high. It'd be the equivalent of you walking down the street with $10,000 in cash in your pocket. Someone's going to say, hey man, that's not a good idea. You could be earning money with that, doing something else with all that cash as opposed to just sit there on your books, or in the case of you walking down the street getting robbed. So that's something to think about. The term comes from the way gold miners would test whether their findings were real gold or false, and unlike other metals, gold does not corrode in acid. So if the nugget didn't dissolve when submerged in acid, it was said to have passed the acid test. If a company's financial statements pass the figurative acid test, this indicates its financial integrity. And now you know. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.